Good morning. Hi, this is Dan Moorhead. Thanks for joining this call on the case for blockchain investment. We host a call once a month with themes for the community to get dialed into what we see as the most asymmetric opportunity in a generation. What we wanted to do is bring you all together with our entire investment team. Joey Krug, Paul Vrata-Talkett, and the rest of our investment team are on the line with me here as well. We'd be happy to answer your questions. So if you have questions, feel free to put them in the Q&A box. We'll answer them live as we go and only hold back the handful that are of general interest for the end. And we're also happy to answer questions verbally after the end of the presentation. So some of you know the firm very well, but some are new to the firm. So I wanted to give a bit of a background on me and Pantera. I started out as Goldman Sachs' first asset-backed securities trader in the 80s, and we're now doing asset-backed tokens, so the world comes full circle. And then went to Tiger Management, where I helped Julian Robertson invest in disruption. Tiger wound down to a family office. I founded Pantera Capital in 2003. For the first decade, we managed $1 billion in normal hedge fund strategies. But in 2011, I got interested in Bitcoin. It took a couple of years to get my head around it, but came to the conclusion that it was such a big disruption, such an asymmetric return, that we would pivot the firm to be exclusively blockchain oriented. In 2013, we launched the first cryptocurrency fund in the United States. We've subsequently launched the first of each of 4 different types of funds. We launched the first fund that invests in venture companies that are exclusively blockchain oriented in 2013. In 2015, my co-CEO, Joey Krug, launched the first initial coin offering on Ethereum. His project is called Augur. And then in 2017, we launched a fund that invests exclusively in early stage tokens. Those span the entire spectrum of the blockchain investing universe. The firm currently manages about $3.5 billion, and we'll go into the funds themselves as we go. So I'm going to cover the case for Bitcoin. Bitcoin is the first cryptocurrency that's viable and functional. We had 30 years of attempts to make cryptocurrencies that work. Bitcoin is the first to get it right. Now we have 3,000 versions of cryptocurrency. It's a way to move value around without using centralized counterparties like banks or credit card companies or remittance companies. The technology has been developing for 12 years. But the real impetus is the monetary stimulus, which comes in reaction to the virus. The US is now printing more money each month than it did in the first 200 years of its existence. The chairman of the Federal Reserve said literally unlimited money printing was on the table. And when you have a unlimited quantity of paper money chasing things which have fixed quantities, like gold, real estate, the S&P 500, or Bitcoin, the price of those things goes up dramatically. You can see that on the left graph. The price of cryptocurrencies is skyrocketing. Bitcoin's up a lot, but Ethereum and Polkadot are up even more. And it's very coincident with the change in money supply. Money supply exploded at the end of March in 2020, so 12 months ago, and that's right when Bitcoin exploded. We wrote in our March 2020 investor letter that we thought that Bitcoin and other cryptocurrencies were going to explode up because of this money printing, and it's definitely happened. The other big thing that's happened in the last 12 months is corporate treasuries are now very engaged in cryptocurrencies, particularly Bitcoin. We have companies like Tesla Motors, very high profile, CEO talking about buying $1.5 billion worth of Bitcoin on their balance sheet. MicroStrategy's public company that's done quite well by buying Bitcoin and then issuing subordinated debt to buy more Bitcoin, and then investors buy their stock and their stock goes up. And then companies like PayPal and Square have issued very easy access to hundreds of millions of people to be able to buy Bitcoin. Square's also put it on its balance sheet. We've had legendary investors like Stanley Druckenmiller, Paul Tudor Jones, Bill Miller get invested in cryptocurrency, Bitcoin in particular, over the last 12 months. And that's really eased the opportunity for institutional investors to, bring that forward to their investment committees. And how does one value Bitcoin? It's a question people ask a lot. The answer is pretty simple. It's Econ 101 supply and demand graphs. There is a very small new supply of Bitcoin that's issued, and there's very strong and growing demand. And over the last 12 months, we've seen both of those things happen. The supply of Bitcoin has been cut in half. That's part of the original construct of Bitcoin. Originally, every 10 minutes, 50 Bitcoin were issued, and then every 4 years since then, that number has been cut in half. We now issue 6.25 Bitcoins per 10 minutes. So money supply is fixed and known, and that is why it is, very similar to a gold standard type monetary regime. The supply gets cut every 4 years. That reduces the amount available, and in order to equilibrate supply and demand, the price has to go up. That's happened in the past. We'll go over that in the next slide. The big change as well is the demand curve is shifting, with firms like PayPal bringing in 300 million new investors into the space. That shifts the demand curve up. And the observation I would make is it seems like demand's pretty insensitive over the last 12 years. The compound growth rate of the number of people using Bitcoins has been actually relatively consistent. So there is kind of a consistent interest in Bitcoin, more people telling their friends, their coworkers, driving the demand. So demand is relatively flat across any price, whereas the supply is really the opposite. A lot of people hold Bitcoin for the 5 to 10 or even political philosophy type horizons and don't want to sell it. So it takes a very steep change in the price to get people to sell. So with the demand curve shifting to the left and the supply, the demand curve shifting up and the supply curve shifting to the left, it's causing the price to rise rapidly. This is something we actually forecast last April. The next slide has our prediction for the price of Bitcoin from our April investor letter. The price was in the 8,000s at the time. We thought it would hit 115,000 later in the summer of 2021. The amazing thing is it's been right on track. There were a couple of months it was a bit behind schedule, but since then it's basically hit each milestone right on time. It's obviously a bit too good to persist forever, so we might have some variations over the next 6 or 8 months, but our view is we're in a very strong bull market for crypto in general. We're very bullish on Bitcoin, but we're even more bullish on Ethereum and projects like Polkadot. And with that, I will hand it to my partner, Jody Krug.
Awesome. So I'm going to walk through, the case for Ethereum and decentralized finance. So I think if you think about, what's happened in the blockchain space to date, initially with Bitcoin, the main breakthrough there was it created, basically a global store of value. People call it digital gold. From a technical standpoint, Bitcoin also solved the double spend problem. Basically, how do you send money in an electronic form anywhere around the world without trust, where you can be sure that somebody is not going to be able to spend the same money twice. And then nothing really changed for a while until Ethereum came out. Ethereum launched in 2015. And the idea behind Ethereum was, what if you add programmability to the money? So Bitcoin is just sending money from one person to another. Ethereum lets you engage in actual financial contracts. It can be anything from a loan to trading to speculation on derivatives, all the way to betting, to insurance. Just kind of anything you could think of that could be codified as a financial agreement or a financial contract. Ethereum lets you build. The next sort of wave of things we're seeing after Ethereum is things like Ethereum 2.0, layer 2 is on top of Ethereum, and other blockchains like Polkadot, which are more scalable than Ethereum 1.0. I think one thing that you'll see in the future is, interoperability, this idea of how does one blockchain interact with another blockchain in a way that's fairly seamless? How does that actually occur? And that's going to be something that's going to become a big theme, probably over the next 4 or 5 years. And so if you think about the concept of decentralized finance, or some people say open finance, the way I think about it is, similar to how the internet was kind of the beginnings of a new information infrastructure, blockchain tech is basically the underpinnings of a new financial infrastructure. And so kind of what does that mean? Well, if you think about the fintech landscape today, it still uses the same existing rails under the hood. So you have basically these glorified UIs that look really pretty. Most of the fintech apps that are really popular today, they look awesome. They look really simple. They look elegant. They're way prettier than, say, an old school Wells Fargo banking UI. But the problem is it's still built on the same kind of underlying infrastructure that isn't very good. It's slow. Things take a really long time. It's expensive. There's a lot of middlemen. Things often just don't work, or bugs happen. So there's a lot of issues. And so DeFi is basically the concept of how do you just rebuild that from scratch using technology that enables everything to happen pretty quickly and seamless. And if you think of finance, there's really, I would say 5 components of a financial system. You have a unit of account to denominate transacting in. For most global trade today, that's the US dollar. You have exchanges that let you trade assets. You have the actual assets themselves. There's, equity-like assets, and then there's debt. And then you have margin and leverage that allow you to basically, bet more than you would be able to in a system that was fully collateralized. And all of these components are getting replicated in the DeFi ecosystem. And so if we go to the next slide, we can basically see kind of what the landscape of DeFi looks like today. At the very bottom, you have new layer 1 blockchains, things like, Ethereum, Bitcoin, Polkadot. One layer up from that, you have platforms that enable you to get data about the real world into the blockchain. These are called oracles. Then above that, you start getting into actual user-facing applications, lending protocols like Maker, Avrien, and Compound, decentralized exchanges like 0x and Uniswap and Kyber, actual decentralized marketplaces, things like Origin and Audius. Origin for kind of like sharing economy and NFT use cases, and Audius for audio, and then payments and stablecoins. Terra is a really fascinating project in this space. It's been growing extremely rapidly. They power a ton of payments in Korea, and they've also been launching kind of some new spin-off projects. One's called Mir. It's a decentralized derivatives exchange that lets you basically trade synthetic versions of things like Apple stock, except what's neat is you can trade it 24/7, 365 days a year. There's no market hours, and you can trade it kind of globally. You don't have to be in the US to be able to access it. And then the kind of layer at the very top is aggregators and wallets. So these are things that are kind of really close to the end user. If you think about something like 0x or Uniswap, you may not actually want to go directly to Uniswap or 0x. You may want to route your order across a bunch of different decentralized exchanges to ensure that you get the best rate. And so there's the aggregators like 1inch and Matcha that basically do that for you. There's also platforms like Instadap. They're sort of like, a bank, but where you own custody to your funds. And so it lets you, use all these DeFi lending applications. It lets you refinance your loans. Anything you can think of in traditional finance is really starting to be rebuilt in DeFi. Even things like structured products are actually starting to happen in DeFi now as well. And so if you look at it from a growth standpoint, the space has been growing extremely rapidly. 2 years ago, there was only a couple $100 million value locked in these DeFi applications. These days, it's around 40 billion. And then if you look at it from a usage standpoint, how much trading activity is taking place, that's one metric. Another metric you might look at is how much lending and borrowing is taking place. But on the trading side, February 2020, there's roughly $1 billion in decentralized exchange volume a month. February 2021, it's about 74 billion. So it's a 74x increase, which is insane. What's even crazier is that a lot of these DeFi protocols trade anywhere from 10 to 50x their implied earnings. So you have a space that overall is growing, through 74x in the last year. Even if you look at the last month's growth, it's growing, 15, 20% month over month. And the revenue multiples are way lower than what you'd see in the tech equities markets. So we think DeFi is really, I think it's really, even though it's seen a big run up, I think it's actually really underbought and underowned. The next thing that you see is stablecoins. So the majority of stablecoins are issued on Ethereum. And the reason is most of the DeFi activity takes place on Ethereum. Ethereum, lets you do a transaction, it takes about 30 seconds. And so it's kind of the main platform that people both do decentralized stuff, but also issue even more centralized assets on top of. The most popular one is still Tether, followed by USDC. One interesting thing about Tether is potential investors tend to ask us about Tether a lot, especially because of the lawsuit. One interesting thing is that based on the outcome of that case, it looks like for the most part, Tether was backed. There were times when their bank account got frozen, which, made it sort of unbacked because the money was frozen. But it doesn't look like they're operating, at some super low reserves or anything like that. So that's actually a really healthy outcome for the space. And I think that cloud over the market is sort of gone at this point. But then you have things like USDC, which are just growing so rapidly. If you don't want to use Tether, you don't have to use Tether at this point. Next, if you look at Bitcoin and Ethereum dominance, so in 2017, they got really close. Ethereum almost actually flipped Bitcoin at one point in terms of like their relative market caps. I don't know if that's going to happen again, but I think the dominance of Bitcoin is going to continue to decline over time. And I think it's especially going to continue to decline as we progress in the bull market. Towards sort of the second half of any of these bull markets, Bitcoin's dominance tends to decrease. And I think that's going to be filled up by, Ethereum to some degree, but also DeFi to some degree. It's been like 2 weeks since I looked, but last I looked, DeFi was roughly 4 to 5% of the market cap of the space. And there's no reason, in my opinion, why it shouldn't be 20% of the market cap of the space by the end of this cycle. And so that has to come from somewhere. The biggest asset in the space is Bitcoin. We think Bitcoin's going to go up, but I think the other assets are going to outperform it on a relative basis. And then so on that note, looking at Antera's performance since 2020, since January 1st, 2020 to present, our liquid token fund, which is a fund that trades the kind of liquid, I would say roughly top 75 of cryptocurrencies on CoinMarketCap, that's up 1,440%. Our early stage token fund, which is investing in, what used to be called ICOs, but basically early stage tokens before they're launched, that's up, 1,817%. And then our Bitcoin fund is up 656%, and that's basically roughly the same return as Bitcoin itself. If you look year to date, our liquid token fund's up 297%, our early stage fund is up 194%, and Bitcoin's up 91%. And I think that outperformance on a relative basis is going to continue, as we continue through this bull cycle, because I think that, as I mentioned in the last slide, I think Bitcoin is going to underperform on a relative basis. But I think all of this stuff is going to go up. Bitcoin's going to be a great investment. I just think ETH and DeFi assets and some of the other stuff in the space is going to beat it on a relative return basis. So now we're going to talk a little bit about portfolio construction and what the portfolios look like. So our liquid token fund is trading across the sort of public spectrum of digitally traded cryptocurrencies. I'd say the fund's roughly 80% or so discretionary. So this tends to be things like buying assets that we fundamentally believe in, that we think have strong fundamentals, but also trading them around. Like we took risk off in January and then bought it back in after the market went down 20%. We took risk off in February, bought back in after the market went down 20% or 25% in that case. And so we'll do these kind of high confidence trades, but we're not trading like every day. For the discretionary portion, it's more when we think there's a really high confidence setup where the things that we look at, which is on-chain indicators, sentiment, and then technical indicators, when those things align, I think it makes sense to trade based off of what they're saying. And then during the times you're not trading, you want to be holding the best assets in the space that are the strongest from a fundamental standpoint. The remainder of the fund is quantitative. And so, the quantitative sleeve is trading on an hourly frequency. And that's pretty uncorrelated to what the rest of the portfolio is doing. So it provides a nice element of diversification. And so if you look at, our fund relative to the market, I'd say we've taken a different bet. And the bet basically is we're underweight layer ones, although there's still about 43% of the fund, and we're overweight, DeFi, smart contracts, and open finance use cases. So if you look at the overall space, I'd say 80% of it or so is layer one blockchains, things like Bitcoin, Ethereum, Cardano, Ripple, that kind of stuff. We basically underweighted that, and we've overweighted things like decentralized lending protocols, decentralized exchange protocols. There's some DeFi protocols that don't really fit clearly into one of those buckets, and that's 9% of our AUM in this fund. And so I think that's sort of where I think the most upside is in the market, and also where things are strongest from a fundamental standpoint. You can buy things in the space right now that you just couldn't get anything remotely close in the traditional equities markets when you look at the equivalent of price sales growth multiples.
Hey guys, this is Paul. So on the early stage fund, if you guys remember, it is investing into early stage token projects before they actually launch their token. So investing that early, sometimes you're just investing into a team, but usually you're investing into a team, a concept, and a strategy going forward. What they need help with is really capital to figure out, how to deploy the regulatory strategy, building a team that builds a product, and figuring out token economics and the technology and user acquisition strategy, marketing, business development. These are all things that we are very hands-on with our companies that we invest into. And of course, when they actually go out there and they launch a token, we help them build community and then help them get listed on exchanges. So typically we're investing into these projects at a favorable discount to the token price when it actually lists. Usually there's a valuation or sometimes there's a discount, but usually it's a fairly significant valuation discount where we may be investing anywhere from a 10 to 50 million token network valuation, and these days they're going out and hitting the market at maybe around 2 to 300 million token network valuation. And the strategy for this fund is investing early, helping these companies throughout their life cycle, and eventually selling out of our position and going back into another early stage token project. If you look at the slide, we have two funds: an early stage fund that is for domestic investors and an early stage token fund for international investors. And you can see some of the terms there. And primarily we're investing into, in 2017, we're investing into a lot of scalability protocols. Now, most of those have launched and have matured. A lot of the fund is in Polkadot, and now we're investing mostly into decentralized finance protocols and potentially other sorts of consumer use cases around, decentralized social networks. Joey mentioned structured financial products, etc. Looking at some of our sample investments, I'll go from bottom to top. We were one of the largest investors in Polkadot, which is a competitor to Ethereum, bringing more scalability and interoperability for a smart contract base layer protocol, allowing you to launch your own blockchain and have it be secured by the main chain. And Polkadot has done very well for us. I think it's been about 100x investment. And we continue to be very supportive of the ecosystem. They're going to be launching parachain auctions, and we can basically help our portfolio companies or other companies basically get a slot into the Polkadot network. On top of that, we're continuing to invest into companies built on top of Polkadot. I think they are probably second of all the Ethereum, second in the entire ecosystem, and right behind Ethereum in terms of just having the developer mindset for just sort of executing on, a smart contract strategy. So, we're really excited about those guys. Akala Network is the first company that we've invested into building on top of Polkadot. They're building DeFi primitives on top of Polkadot, and basically allows you to, have a decentralized exchange. You can stake, and they actually are launching their own sort of stablecoin primitive. And we think a lot of DeFi applications will be built on top of Acala because of the tools and services that they have. And then the last project that I'll talk about is Injective Protocol. Injective Protocol is a decentralized derivatives exchange that's built on top of Cosmos Tendermint, which is another scalability protocol. They have done a pretty good job of building a very strong community and a very strong investor base, in addition to some of the typical crypto investors that are investing into DeFi these days. Recently, they just got Mark Cuban to invest into Injective Protocol. So it looks like we're getting more mainstream investors interested in DeFi. What they've also done recently is they've gone a bit more cross-chain. So they've built on top of Avalanche. They've also enabled synthetics derivatives trading, so you can trade Amazon and Tesla stock on top of their platform. They're about to launch their staking mechanism, and they just partnered with Tidal for decentralized insurance. So they are moving really, really quickly in the space, and their mainnet should be launching in April. The next fund we'll talk about is the Pantera Bitcoin Fund. So I think of the Pantera Bitcoin Fund as a white glove service to get into just Bitcoin. We're starting to see a lot of interest from institutional investors that are just seeing the wave of momentum with corporations putting some of their treasuries into Bitcoin, and global hedge fund managers also diversifying into Bitcoin. For them, they see, especially during this pandemic, the digital gold narrative, and it is for them easier to get into a hedge fund vehicle and be able to sort of get exposure to the price of Bitcoin without any sort of premium, with having the sort of liquidity that the Pantera Bitcoin Fund provides, and really just the customer service and the branding that we sort of wrap around this Bitcoin fund that makes it attractive for a lot of institutional investors. So just to get into a little bit more detail on how the Pantera Bitcoin Fund compares to some of its competitors, you can really just take a quick look at this, this chart right here. I think the main differences are really just, getting in and out. The total fees and expenses are cheaper going through the Pantera Bitcoin Fund. There is no premium like the Grayscale Trust, and it's daily liquidity. There's no lockup. It's open to both U.S. and non-U.S. investors, and it's just been a fund that's been around since 2013, and it's returned billions for investors. Everything is sort of check the box in terms of custody and in terms of just the sort of auditing and all the bells and whistles in a very simple hedge fund manner. So if you are thinking about deploying at least $50,000, $100,000 into Bitcoin, the Pantera Bitcoin Fund is a very seamless way to do so. So that ends the presentation. I think for the rest of the time, Joey, myself, others will be happy to answer any questions.
There's a question about rates, interest rates in Bitcoin price. There's definitely a correlation there. It's not extremely high of a correlation, but there's definitely one there. I think all else equal, if rates skyrocketed, that would be bad for Bitcoin. Because I think today, it's a risk-on asset, but I think it's extremely unlikely that the Fed's going to raise rates anytime soon. Most of the market seems to be forecasting there won't be a rate hike until 2023. So I think whatever happens in interest rates is sort of irrelevant for this crypto bull cycle, because I think it's going to be over before that anyway. And I think if there's some inflation and the Fed doesn't raise rates, that's actually really good for Bitcoin. So I think if anything, from like an EV standpoint, what's happening in macro is probably fairly positive for the price of BTC. There's a question about is the 115K thing of our prediction for the peak of the cycle? No, I think that's just what the stock to flow model says. If you look at historical cycles, usually the price actually exceeds what that model says at some points, and that's kind of when you see a blow off top. So 115K is kind of like what the model quote unquote says is fair value, but it usually goes higher than that. There's a bunch of questions about like how to avoid drawdowns in towards kind of the end of the bull cycle. I think the way I think about that is sort of the same sort of reasons you might take risk off during the middle of a bull cycle, which is you tend to see two or three things kind of happen at the same time. One is you see the on-chain metrics tend to get very overbought. There's a lot of interesting metrics there, things that basically let you figure out, what kind of multiple of unrealized gains is the average holder sitting on. And when that tends to get too high, when you see a drawdown of 5 to 10%, sometimes it can kind of spiral into a further drawdown as people sell to lock in their gains. And so when that kind of aligns with, bearish indicators from like a technical analysis standpoint, those tend to be fairly plus EV trades to take risk off. And then the reverse is true when putting risk back on. So we've been doing that throughout this cycle. We took some risk off, all the way back in March 2020, then reverted it back on near the lows. We did the same thing January this year and did the same thing February. And I think, we're going to probably keep doing that throughout the rest of the cycle. And then if things get really overheated, we would take more risk off. Typically we take, we've been taking something like 20 to 30% risk off. When we think that it's the actual, peak, we would take much more risk off than that. Something north of 50% is how I envision it.
Yeah, this is Paul. I can talk a little bit about our view on NFTs. I mean, we're seeing a lot of activities on NFTs right now, especially in the digital art space. In terms of our specific portfolio companies, two really sort of stand out. Origin just did a NFT collaboration with 3Lau or Justin Blau, and they sold sort of his music album with some exclusive tracks, and that garnered I think $12 million in total sales. And so with that platform that they've built, both really on the design piece and also on the tech side to sort of facilitate that sort of sale and auction, they're looking to partner with other influencers and celebrities to do the same sort of thing. It could be around music, it could be around other types of content. So really just being the Shopify for NFTs. So if you guys do have any sort of celebrities or influencers that want to launch their own NFTs, then Origin is a good partner to potentially talk to. And then on the Audius side of things, what's interesting is they are doing really well in terms of building up their user base. I think they have 3.7 million monthly active users. And again, this is a decentralized streaming service for music, sort of a decentralized SoundCloud. What they could potentially do is, as you're streaming music, sometimes you want to potentially own some of these titles, and so they could basically tokenize some of the titles that you're most interested in owning and create it as an NFT, and then you could basically create an NFT playlist of music titles and things like that, and be able to have it be shared among different users, etc. So it's almost like being able to sort of download your MP3s instead of just listening to them on a streaming service, and that could be sort of interesting. So they're figuring out different ways to start with music NFTs, and then potentially their platform could be, with that user base, be able to consume a whole bunch of different types of NFTs.
There's an interesting question about Bitcoin and then other cryptocurrencies on the market. There's 3,000 other cryptocurrencies in one Bitcoin, so there's no scarcity on everything else. And so how do we think about prices of other cryptos given that? And I think there's two aspects to that. One is if you're trying to compete with Bitcoin, I think my response would be good luck. But two is most of those assets, they're not trying to compete with Bitcoin. If you buy a Uniswap, you're basically buying claim on the future cash flows of the protocol. It looks much more like buying a public company stock as opposed to buying something like Bitcoin. And so from that standpoint, it doesn't matter that there's 3,000. There's tens of thousands of startups in the U.S. and it follows the power law. Only some of them become unicorns, and only some of them become decacorns, and only some of them become $100 billion companies. But it doesn't mean that it's not worth investing in the best ones. And so I think that's sort of the same thing here. When you invest in something like Uniswap or Maker, you're not thinking that you're buying something that's a better version of Bitcoin. You're buying the claim on cash flows of that protocol. There's a question on Ethereum 2.0. I think it's very important that Ethereum 2.0 launched successfully. The very kind of early phase 0 of it already came out. But with phase 1, it actually starts to open up a huge amount of scalability when you combine that with this technology called optimistic rollups. So I think Ethereum's scalability problems, a large chunk of them will be solved by the end of this year. And then I would think, the vast majority of them will be solved over the next couple of years. I think it's actually going to work, and I think I'm pretty optimistic about proof of stake and Ethereum 2.0 and rollups. There's a question about what's the time frame for holding coins other than Bitcoin and Ether. How do you think about the hold period of a given asset? I think it's sort of like you buy an asset because you think it's fundamentally undervalued relative to the market. And then you have some thesis when you buy it. It could be that it's a decentralized derivatives exchange and it has, way less, a way lower valuation than everything else relative to it. The traction is really great. And then like the team is doing a really good job. And so you would buy it. And then the only time you'd really want to sell it is if the thesis changed, right? So if it became extremely, extremely overvalued relative to the market, or the team was no longer executing good, those sorts of things. And so I would say there is some turnover in our liquid token fund portfolio in terms of the universe of tickers. I'd say probably on a quarterly basis we add or remove one or two things, but most of the activity is surrounding changing relative weights of positions, and then also kind of trades like Bitcoin ETH dominance trades and risk off, risk on sort of trades. There's a question about do we short? Not really. We don't really short stuff for the most part. We've done some things by like buying put options if we think that an asset's really going to go down, and I think that's fine. I think going to cash is fine. I think shorting in crypto, outside of like doing it, algorithmically with relatively short time horizons, I think it's pretty risky. Other than that, if you're doing something where you're shorting on like an hourly basis and you can get out of it pretty quick, that's one thing. But if you're just like buying a big short position and holding it overnight, that can easily blow up when assets in the space sometimes go up 30% overnight. There's a bunch of questions about taxation. If you have a specific question about taxation in the funds, you can email our CFO, Ryan at panteracapital.com. There's a question about time frame. How long do we see this cycle lasting? And then there's another question about like, do we think this is a super cycle where it'll have like a double top like 2013? I think this cycle probably lasts through the end of the year. I would be surprised if it lasts till the end of next year. And I don't think it's going to be a super cycle kind of thing. The space was so much younger back in 2013. There have been a couple of opportunities where it could have had a super cycle, like the January big run up and the February big run up. There were points where it could have went up another 30 to 40%, had a blow off top like 2013, came back down, and then we could have done that again closer to the end of the year. But both those opportunities that it happened, that didn't actually happen, and instead the market just went down, 30%, blew off some steam, and then resumed the uptrend. So I'd be surprised if there's another like 2013 style double top super cycle thing. I think that might have been a one-off. There's a bunch of questions about March returns. Looks like the fund's up a bit over 40% in March, and then Bitcoin's up a little bit below 20%. Bloomberg looks like it's up around 25, 26%. Just to give an idea for that. And then there's a question about Cardano, which I've been getting a lot recently as well, just because it's in the top 5 assets now. I think, it's interesting. I think most projects that we see building DeFi applications are built on Ethereum. I would say the split is basically 90% are on Ethereum, 5%, maybe 5% are on Polkadot, and then 5% are on a random list of other stuff, like Solana, Near, Avalanche, maybe Cardano. But I actually haven't seen any projects pitch us that are built on Cardano. Maybe one or two that I'm forgetting, but I haven't seen it. So I think just on a relative basis, like I'd rather own Polkadot than Cardano, and I'd rather own ETH than it for sure. I think we've touched on most of the main questions. There's one other kind of category of questions, which is like we haven't touched on yet, which is like, what's our view on oracles, like Link versus API 3? I think if you look at like Chainlink, the concept is basically you have like these nodes that run software that basically fetches data from like traditional web services and puts it on Ethereum. The idea behind something like API 3 is instead of like fetching the data and then throwing it on Ethereum, why don't you just go to the service directly and ask them, hey, would you be willing to put this data on Ethereum? We'll make it really easy for you to run a piece of software that does it for you. That's like just a different approach. I think it's an interesting approach because you're basically getting that, company or institution's credibility directly. Like if they put a bad result on chain, it actually hurts their credibility in the real world. And it's sort of officially sanctioned by them, which I think is an interesting approach. But I think and then there's like a third area of oracles, which is like Uniswap style price feeds, where you just get the price from Uniswap using like a time weighted average price, which is another interesting approach that works for some use cases. And there's one last question I wanted to touch on, and then I think we'll wrap it up. There's a ton of questions in here, but I think we've answered kind of most of the main categories. And if you have something else that didn't get answered and you really want the answer, feel free to email us. Our emails are just our first name at panteracapital.com. But the last question I want to end on is, somebody asked a question about new investors are basically buying into funds which have performed really well. How do you think about future performance given that? And I think if you look at where we're at in the cycle right now, I would say we're a bit over halfway through, and most of the absolute gains happen in the final portion of any of these bull cycles. If you go pull up the charts for 2017, the run up from July 2017 to December 2017 was huge, and I think that's sort of the part of the market we're in right now. Maybe it's only June, or maybe it's May, or maybe it's July, like I said, but that sort of feels like where it's at about right now, just based on what we're seeing in the private markets, how the public markets feel, kind of what the level of exuberance in the space is right now. And so I think there's probably, if you invested now, like I think it's a pretty good risk reward time. If you were going to invest and you wanted to invest, 9 months from now, like that would actually might not be a good decision, because that would be like right around or shortly after the peak. So I think that's sort of the thing to keep in mind is like, if you are going to invest in the space, like you should probably do it relatively soon, as opposed to waiting until, August or September, because by that point, on the super liquid side of things, we're going to be approaching the peak of the market. And of course, we're going to try to do what we can to mitigate that. We have a risk off strategy where we plan to take a bunch of risk off when we think we're near the peak. But even if we do really well on that, you're probably going to miss the first 25, 30% of the drawdown because the market moves so fast. When crypto draws down, it draws down really hard and really aggressively. It can happen over a 4 to 8 hour period even. And so when you look at the kind of the level of AUM we have, you can't trade everything that quickly. It might take a day or two to get out of the markets. So that's sort of the thing to be mindful of. I think right now the market is in a relatively healthy condition. It doesn't really seem overbought or oversold. It's sort of, close to where fair value should be given this phase of the bull market right now. And so with that, thanks everyone for joining. If there's anything we didn't answer, feel free to shoot us an email. Thank you.